Good afternoon, folks. Welcome to Market Trends. This is David Russell, Global Head of Market Strategy at Trade Station. It's great to be with everyone. Today is Thursday, September 11th, 2025. I'm going to show you a few disclosures and also just mention it's very interesting when you look at the news today. Warner Brothers Discovery is rallying on a report that there might be a takeover bid from Paramount Skydance. Micron Technology has a big rally today on a city note saying that it could have positive news like Oracle. Well, I don't know exactly like Oracle, but kind of following the same vein. And then the other things we have is, of course, the Oracle number itself earlier this week. And I think the overall message in all of this is simply the fact that um, the news continues to surprise in a positive direction and sentiment remains extremely negative. So before we go on, I wanted to also remind you guys that I'm going to be speaking on September 24th, 2 weeks from now, in Chicago at the Derivatives in Focus Masterclass. If that's interesting to you, you can sign up with promo code DRussell100 and get $100 off your ticket. So to do that, you go to tradestation.com, you go to learn, and then you go to Masterclass, and you can sign up there. So also, if you're on tradestation.com, you can scroll on the page and you can look here for this blog post. New stocks break out as volatility fades. That is the kind of summary of our webinar today, and we're going to be going through those points. Before we do that, though, I do want to show you the standardized returns of some ETFs that we may or may not be talking about. Remember, there is a link also in the description to our ETF prospectuses page if you're interested in those. So today we had CPI, and in some ways, like in this kind of market, it's just not a hugely important thing at this time. I think it's important to realize when you look overall at the S&P here. Actually, bring up this S&P chart. This is essentially the one from the blog post today. But I think right now, in many ways, yes, there is some inflationary evidence or pieces of inflation trickling through to CPI. But the point is, at this point, is it's not that bad yet. It does not undermine the idea of a rate cut next week and further rate cuts in October and December. But I think the key thing also is the fact that the jobless claims were the highest in over a year, higher than expected. Now, there is some talk that they were pushed up by something in Texas, some weird anomaly from one big state. That may or may not be true, but I think that's not even as important because when you look at the overall situation, we had last week, the payrolls were weak. This week, we saw a downward revision, significant, I think the biggest downward revision ever of previous yearly data. So these things overall kind of give the sense that the American economy is kind of limping. The job market is limping. Inflation is not going away, but it's also at a point now where the Fed's kind of balance. It's when if jobs are really strong, then they're going to be fighting inflation more. But the more jobs weaken, the less hawkish they're going to be fighting on inflation, and that's kind of where we are right now. I think it's important to realize that balance is kind of tilting. So that I think is the way to understand this right now. And at the same time, we're going into a situation with, I think, dramatically negative sentiment. It gets worse and worse all the time, and it's a wall of worry. Meanwhile, M&A happens. Stunning surprises like this Oracle number come out and really surprise people. Things like today the I don't know if it was an upgrade or just an analyst note, but someone said that Citi said Micron could have very strong guidance when they report later this month. So these are the sort of forces that are now kind of at work. And as I look right now, I think that we see the overall AI trade. It's important to realize it started with NVIDIA, and stuff like that. It spread to Palantir, Microsoft, Amazon, and Google. But it's interesting to see. There's a lot of industrial stocks in there. There are multiple industrial stocks like FIX, that were, it's like an air conditioning stock that has become, to a certain extent, an AI data center trade. There are the utility stocks that, I think stunningly, we did a trading view idea on this one, but last year, Constellation Energy, CEG, was one of the biggest gainers in the entire S&P because of nuclear energy and the link to AI. I think we all remember this. The key thing is that this AI trade just keeps spreading, and here it is now trickling through to these other areas. Like Oracle went from being this kind of forgotten dinosaur to almost $1 trillion company, and that's what's happening. And now we look at Micron as well today. So I mean, these are the kind of aspects of in many ways, I think a market that is really the perfect kind of conditions for bullishness, because sentiment is so negative today. The American Association of Individual Investors, the sentiment went to the lowest level since April 30th. The bearish was the highest since May 7th. We look at the National Association for Active Investment Managers. They do their number. It drops to the lowest level since late June, which also shows less exposure. And then, I think we also see the VIX continuing to kind of, push lower. So these conditions overall, with surprisingly, with good news surprising to the upside, negative sentiment, and the Fed tilting in a dovish direction, these things create the risk of the market going, actually more aggressively to the upside and being less, kind of more euphoric. That's what these sort of environments sort of can argue for. So I also want to talk about briefly some of the things we're seeing globally, because as the United States has been seeing this kind of economic data with kind of weak employment and things like that, what's interesting is if you look over in Europe, the ECB had a meeting today, and the European Central Bank, more or less, they raised their economic growth forecast, and they also more or less signaled they're not going to cut rates again. So we have the Americans getting more dovish and the Europeans getting less dovish. And I think right now that puts us in a spot where if we look at the dollar, we could be setting up now. There's a dollar index. So here we are, dollar index. Let's take all these extra lines off. The key thing is, let's move this line down here. This is over in TradingView now. Now remember, we talk about these a lot on a state of the market that we do on Monday afternoons. But if we look here, the dollar index, has basically now consolidated pretty substantially below that the 2023 low. And, people might be looking now for this to move down toward 90, toward the level that we saw back in the middle of 2021, before the inflation and Fed worries picked up. Now, remember, this period of time was American exceptionalism. This was when the Fed was raising rates, but also the Americans had done the Inflation Reduction Act, which caused significant stimulus and economic growth and industrial investment and all of that. This caused the period of American exceptionalism, strong dollar, fiscal stimulus, and in many ways, it's been fading since somewhere around here, kind of. And so it does create the potential now, despite all the things you read about the French government and budget and all these things being in chaos, the European market's going up. I think we have to realize just overall that weak dollar can reassert itself. And we look at gold rallying and silver rallying, European stocks rallying, and the dollar not moving yet. But this might be something, if we look at the euro here, that this could be in some ways with the weekly chart here. I mean, I'm going to turn this to a daily chart here. And I mean, I think right now the euro is in a spot where people might see the potential for this to extend. And what do we have? Wednesday, next week, Mr. Powell and his press conference and their dot plot, Wednesday, 2 p.m. Eastern. So I think right now, these are things that the market might be kind of looking for and seeing a kind of cascading flow into the euro and into global stocks as that event happens. Now, we've been talking about this. We've been talking about the outperformance in global. We've been talking about the potential upside in Chinese stocks, which has happened. It's kind of interesting to see. There was an article today in something called The Information, which is some kind of I think it's a media publication. It's very specialized, but it has interesting information about advertising, I think. But anyway, The Information reported today that Baidu and Alibaba are going to start developing their own AI chips and moving away from Nvidia. So from my perspective here, if we look long term at the Chinese market, if we look at the Hang Seng long term here, this market has essentially, the Hang Seng has basically been, you know, just inching higher, but it is way below where it was. And I think, this is just something, the valuation and everything else, if there's more of a business friendly environment there and less overall risk, from my perspective here, there's, people might actually see that this can kind of extend and continue. And I want to just kind of put that out there. Some people have kind of, not totally agreed with the situation in China and see other risks and things. And there's always different kinds of risks in the market. But I think what's important right now is just the fact that the dollar is struggling, and there does seem to be a process right now of capital shifting to other assets, not just to global assets. There's American stocks that are doing just fine. Thank you very much, as we're going to talk about. But there is, I think, right now a dominant underlying trend of dollar weakness. That's what we're seeing in all the data. There's a lot of evidence to support it. And so there's another article I saw that was kind of interesting. Reuters reported, citing unnamed sources, but these are normally accurate when a company like Reuters reports something. Reuters reported that JP Morgan is going to increase its Asia Pacific headcount by 20%. So again, Jamie Dimon sees the growth in Asia as well. So from my perspective here, this is something that, there's a lot of smoke with this, to point to this fire. So I think right now the global trade continues. And I think we need to kind of just realize that continues to happen. If you look at the long-term chart of EFA, you basically, EFA is a global ETF. This is now broken out above where it was back in 2007. And from my perspective here, this could be set for a period of extension. So we might want to actually see that this could actually extend to the upside as we embrace a dovish Fed. And people can say it's going to cause inflation and all these other things, and that might be true. Um, it doesn't matter now. The fact is, if the Fed's policies cause problems for the American economy and the American stock market, it will be in the future. At this point, the market's focused on the dovishness, and there's going to be a grace period here. And the sentiment is so negative that I think we have to realize that this is where the market's focused. We've said before, there's a lot of things to be bearish about, but at the same time, that doesn't matter. What matters is what the market's doing, and it matters where the supply and demand is. When you have a huge number of people being bearish and you have a lot of cash on the sidelines and the Fed being dovish, it's hard to kind of embrace too aggressively that bearish thing, because it just does not necessarily really hold up. The other thing is the emerging markets ETF, the EEM. This includes China and a bunch of other stuff, including Latin America. um, Probably some India. I'm not totally sure, but this is actually broken out on a weekly basis here. So from my perspective, EEM, emerging markets, EFA, global. There's a lot of other things you can look at for international stocks that I'm not going to get into now, but I want to emphasize what we're seeing here. The mega story in many ways is potentially dollar weakness, weak dollar trades. Not. I mean, precious metals have moved a lot. But then a lot of these global stocks are in the process of moving. But when you look at them long term, you look at long term EEM. I mean, this thing is nowhere near its all time highs. And so people, well, maybe it's getting near it, but it's still below its all time highs. And this could be something where people, kind of look for it to perform for a few quarters. Um, so I think this is kind of where the focus is right now. I saw another article, I think it was on CNBC, that said family offices plan to increase their exposure to equities, which is kind of interesting. With the S&P, this is another some old markups I have here, but here you are, the weekly chart of the S&P, new all-time high, and they want to buy more stocks. So there you go. I think it actually is consistent with some of the things we've said, which is that essentially there has been a lot of money underweight major American stocks for a long time. And I think it's important to realize that there has been this weird kind of, private equity bubble. And people have been putting their money in these private equity funds and stuff. And it actually creates the potential for some of that money to redeploy to traditional equities. Um, so just so you know, today the American Association of Individual Investors, AAII, was only 28% bullish, which was the lowest since April 30th. And so basically, I'm going to jump over now. If you look over, one of the things I want to really talk about today was just the fact that we have new stocks breaking out as volatility fades. And so I noticed there's just a series of stocks you might want to look at here. For example, we did, Bloom Energy. This thing's been kind of explosive, but I mean, this had all kinds of signals. Look at how it hit the blue line, the 8-day exponential moving average. So remember, we have over in MA tools, we have our our moving average tests. So for example, if you want to look for something that is testing a moving average, this is not going to show up right now, But I mean, I'm going to just go ahead very quickly and just add, for example, the NASDAQ 100 to this, and you can see what I mean. This will actually flag those stocks that are hitting the moving averages. So the idea in some ways is you can look for stocks. So this is just a purely an example, but AMAT, for example, applied materials, you can see here that it lights up this column. That means it's touching that moving average. It doesn't mean right now it's necessarily anything that is interesting. But the idea that I kind of want to share is that if we go up here to the top of the blog post and you see we have our zip file, inside of the zip file, we have the ELDs. Inside of those ELDs, we have custom indicators. Those custom indicators include things like EMA tests. It includes all these workspaces. Once you load those custom indicators, you can then load the workspaces that are all in the zip file. Um, so there's a one of the things I am often doing now is I'm looking for stocks. This is a pretty traditional way to look for momentum is to look for stocks that are hitting new highs, and then I put them on a list. And then when they pull back and do something like hit the 8-day exponential moving average, then you look to buy them. So, for example, if you look here at Bloom Energy, that's exactly kind of what it's been doing here. And when something is in a strong uptrend, you had the breakout to new 52-week highs was all the way back here, and that was at 32, and now it's at 67. So, it broke out to new highs. A few days later, it held that 8-day and continued. Held the 8-day, continued again, again, again. So, how do we find those to start? Well, here's one thing I want to show you guys very quickly. This is a special workspace I have, and it's kind of just like for big, so you can see things with big sort of font and big text. And basically, it's a scanner. So I have something here called New Highs Today. And what I have in this is I'm basically looking at stocks that are near their 52-week high. So I'm using a tool here that is inside of the price folder. All right, so you go to scanner and you go to the indicators here, or these fields, and inside of price, they have percent of 52-week high, low. So by looking at stocks here, that will basically range between 0, which means it's at a 52-week low, 100, it's at a 52-week high. So you can find stocks that are near that level. The other thing that we've included, if you look down here, we have instructions on this, is that we have our days since 52-week high low. So what you can do for this, and I'm not going to do it because it's not fast, it is a slow scan. But I'll actually show you. I have this, I call these, let's see. I call this recent 52-week highs in the S&P or the NASDAQ. And what this scan does is it looks for stocks. It uses this very indicator, days since 52-week high low. I have it set to the number should be less than 21, which means it made a 52-week high in the last 21 sessions. Now realize that this indicator has two outputs, high and low, and you want it to be set to high. So basically, these are some of the stocks that pulled up on that. I have some other things in there. I have it set up so that it hits the high and then it pulls back. So this, in theory, should find bullish flags. So Fox, for example, if we look here over, I'll just very quickly look here at Fox on this chart, just so I don't waste too much time. That was one that made a high and pulled back. Just the ways of looking at it. Anyway, I look at this a lot. So this tool, days since 52-week high low, it's also over here in the in our price grid. If you want to look at something that you can put a stock in like Fox, and you can Fox, and you can see that it also populates there, and it says it made a high 3 days ago. So you can go through and look for stocks that make highs. You put them on your other list with like MA tools, and then they pop up. And then the other one I'm going to very quickly show you is IPOs. We keep getting new IPOs, and they've been performing. Klarna had an IPO yesterday, so we have another tool here for you. I'm going to just run this one quickly. Hope this is also, this might be slow. I hope it's not too slow. But what this does is it basically counts the number of days of history that the stock has in TradeStation's price servers. So what will happen is in most of these tools, there's a little there's a choice when you can say how much history do you want to load. So if you look at a radar screen, you can say I only want to load 250 bars of history, which is roughly a year. So if a stock like Apple will return 250, because basically it has obviously more than 250 days of history, but in this case, it will only pick up 250 because that is what the indicator is looking at. So the idea is what you want to do is you want to look for stocks that have less than 250 or whatever number you're happening to actually put in. So you can actually see that over here. This is going slowly, but if you actually look, the indicator has an actual setting when you tell it how many days of history do you want to look at. And this is now just running. So I wanted to kind of mention that. Um, I'm going to quickly jump over and show you something else I've been wanting to show, which is the Russell. So the Russell against the Nasdaq. So this basically here, am I showing the right thing? I don't know why. Are you too? Sorry. So this basically shows some interesting sort of relationships that pop up from time to time. So for example, um, you can see here, this is back when the AI boom started and everything flooded into the big tech stocks. But then there was this period here, I remember this well, when we had the rates start falling back in October, November of 2023. And at the time we were talking about it, and you can go back and watch those. And we had this rally for a few weeks in the Russell outperforming. Then back there in July of 2024, we had a cool CPI report and we had a brief rally in the Russell. And now here we are again with the idea of the Fed being dovish. So from my perspective here, people might look for more upside in this. So anyway, this did not work very well. It does actually show that this stock has less. I don't know why this is not working. I'll tell you, when I'm live streaming, Scanner often has issues. I think the computer prioritizes who gets data or who gets the actual feed. I'm not sure, so it slows it down. But the key thing here is IPO tool. You'll look at this and you'll see. So this is looking for stocks with less than 100 days of history. And if you actually open up the tool, you can see it's set to low 250 bars. So the fact is that if a company like Apple or something, it would have, more than, it would have 250 bars. So if it has less than 100, that basically means that it has less than 100 days of history, which is a way to find IPOs. And that's useful because sometimes stocks go public and there are some interesting small mid-sized companies that go public. They don't get a lot of attention, but then they start to perform. They get added to indexes and things like that. So I want to just kind of point out, these are some of the tools we have for you here in this in these the zip file and the things we're going to show you. And I mentioned that because the fact is, in this market right now, as we detail here, look at all some of these different companies like Bloom Energy, Kamiko. There's one company that is kind of the dominant. Actually, let me jump back over to TradeStation here. I mean, CCJ, this is like kind of the pure play uranium sort of stock. You look at something like Bloom Energy. You look at a stock like Fabrinet. This company makes fiber optics. They are a kind of not a super well-known company, but they are a major company, a major producer of fiber optic equipment. Another one that you might want to look at. I mean, these have all moved now, but the fact is that these are the sort of companies that have been popping up, and these are the sort of companies like SanDisk, memory. Oh wow, look at that! I didn't look at this one. Now this one, anyway. So the idea is that you want to find things that might be jumping out, kind of looking like that. And some of the ones that might actually potentially be like that I kind of noticed here. Well, right now, CCJ was one that I did think was kind of interesting that people might want to be kind of looking at. Another one, now this has not been hitting new highs, but I think it is interesting, is that Coinbase, crypto has been doing okay here. And Coinbase, has actually pulled back here. And I think people might want to be watching to see it has this gap from earnings back here. But Coinbase is actually in a spot where people might actually see some potential for this to start performing again. Look at it on the weekly chart. You can see that it's kind of consolidating at these levels from the end of last year. So I think right now Coinbase is another one that might be on people's list. Another name that's interesting is AFRM. Now, this company had a really strong earnings report, gapped higher. From my perspective here, it's obviously getting a lot of sellers here, but people might want to look to see this kind of get down under 80. Next week, it might be kind of, probing down under 80, kind of sitting in here, and then people might look for some opportunities in something like a name like this, Affirm. So these are just some of the ones that are kind of popping up for me. Another one that's interesting is RCAT. They do drones, and they had apparently some kind of new deal with the government today. I think it was NATO, actually, not necessarily the Defense Department. Now, another name that's been running is Philip Morris. I'm not really sure why. I'm sorry, Altria Group. But this is another one to me that it was interesting. It rallied to new high, pulled back to the 21-day exponential, came down the Keltner channel and it popped up. So these are some of the ones that have been kind of popping up that came up on some of the scans I do on a regular basis. Now I want to look at a few other things in the S&P 500. So actually, I will show now over on this on TradingView. I'll just show the Russell outright. I mean, the Russell here, you can look at it and you can basically see that the Russell is, getting back to the highs of where it was back here in November and all the way back in November of 2021. Of the major indexes, the only one that has not broken out yet. So I think that's kind of important to realize as well. And when you look at things like these M&A deals and these other things happening, it gives a certain kind of boost to small caps. We're in a period right now where the breadth is shifting in favor of some of the smaller companies. So we look over here at our MT breadth workspace, which is also one of the ones we include for you guys. Today we actually see a new all-time high on the advanced decline line, new high on the S&P. If we look over here at our equal weighted, we can see the equal weighted is outperforming today. And this might be something where we kind of see a bit of continuation and strength as the kind of overall market conditions favor smaller companies and people look for some of the smaller stuff to perform. If we look on our key ETFs, it allows us to see where the strength is. Look in the last week: gold, Chinese stocks, metals, software has had a big comeback. But then you also see kind of at the bottom of the list, banks have been lagging, energy has been lagging. So it's interesting to kind of see that this is, has been very much the kind of focus. And I'm just kind of, to me, what's interesting is, like I said, I've been kind of noticing the EFA coming back to life. If you look on a 63-day period, the EFA, if you look at it, EFA on a year-to-date basis was at 23%. The S&P is at 12. So what happened here was the beginning of the year, we had this big rally. This is the weekly now. We had this big rally in the EFA. And then basically we had a period of consolidation, and that's why the 3 month, which is 63 days, that's why this is behind. So you can see year to date it's strong, 3 month it's lagging, but then look over here at the 1 week, it's up 2% and the SPY's up 1.2%. It's up 1% today, the SPY's up 0.8. So we're seeing the global, the EFA, start to reassert itself after a period of consolidation and lagging. So I think it's interesting to kind of think about it from that perspective. And it's one of the things here that, these key ETFs with these multiple time frames allow you to look at things, clearly from that kind of perspective. Um, Look at a few other things. As you look overall at the S&P, though, I think it's important to realize that 6,600 might now be kind of in the cards. Right now, we are at our current price is 65.82, but 6,200 might be a spot that people are kind of looking to next. As we look back over on this other workspace, this is just essentially our chart for today. Let me kind of reset it. Sorry. There we go. All right, so this is basically the S&P here, but what do we see? RSI, this is what I call RSI is cooking. When it goes up and it kind of just hits these levels and it just doesn't go down much. So I'm not going to scan back, but if you go back and you look at 1995, 1996, this is exactly what RSI did. This looks exactly like the S&P 500 when Bill Clinton was president. I mean, it followed that 21-day EMA higher, and the RSI was like consistently between 50 and 80, and for 18 months. And that is what it's doing here. You can see the rate of change over a 9-day rate of change just barely goes negative. And you have these periods when it basically goes to zero and then it goes back up to one or two, goes to zero, back to one or two. And what does that mean? It means it's going up 1% a month and then it pulls back, 1% pulls back. And that just is that's what a steady uptrend kind of looks like. Money oozing into the market. And this is the kind of market with low volatility. Volatility has not been single digits for a long time. It can do that. So I look at this right here, and the VIX here, I mean, it used to be under 10. It has not gone under 10 since COVID. This was COVID right here. But it can go. If you look where it was in the beginning of 2018, I'm not saying it will, but I'm just saying this kind of environment might actually see the VIX keep grinding down, closer to like 10 or 11. And so I think this environment, that is the kind of thing that, is potentially, what that's the kind of mindset that people have to, might want to potentially have. So I showed you the ratio also of the Russell against the Nasdaq, and from my perspective, this is an important thing. We're in a period now where, in many ways, if people are like, during the period of American exceptionalism, it was the mega cap stocks. That was like your big names. You know, people were not interested in the niche stuff. Now they're looking for niche stuff. They're looking for smaller, more unique things that can outperform, and that I think is what we can see here. So that I think is an important point here. Is that at this point the Russell might be in a period of relative ratio rebound against the Nasdaq, and you know, with a period here of rate cut expected next week, maybe other rate cuts. After that, it kind of gives some runway in front of the small caps. Um, so a few other things I want to very quickly mention to kind of, well, first I want to show you the XLV in our state of the market. This is a different chart, but we basically identified a level around here and we said it had the potential to break out and run back up. But healthcare here, this is what I'm talking about. Healthcare is not, mega cap AI's names. And these are the sort of areas people can look for it to run back up. And I think we're seeing that. And I think it's kind of interesting to see here what's happening in healthcare. It's also a cyclical thing. If you think the American economy is going to have lots of weak job growth and everything else like that, then XLV here has that kind of it has that non-cyclical sort of recession trade that we often kind of see. Um, Another name that kind of I just want to mention is this company called ArcelorMittal MT. I mean, it's a European steel maker, but it just looked to me like it's potentially getting ready to break out here. If you look on the weekly here, so this was to me kind of interesting as well. MT. Um, all right, those are mostly individual names I wanted to talk about. The other thing that is interesting though is the home builders XHB. I'm sorry, what is it? I can't find it now. Trying to find the Philadelphia Home Builder Index. I don't have the ticker here. Sorry. Here it is. Housing sector. So this here, I think, is interesting. The home builders have been moving, and we have next week. If you look over here on our upcoming events, we have right here the housing index on Tuesday. Housing starts and building permits on Wednesday. I just think right now, today we actually saw mortgages have a pretty dramatic drop. Um, the mortgages are down to the lowest level in over a year. Um, can't find it right now, but I did see that. So right now, I think that there is this idea of rates moving lower and that potentially helping the home builders. Another thing we've talked about the potential for an acceleration here are the real estate investment trusts. I know it's kind of a boring thing overall, but the fact is that these are also beneficiaries of low rates. And I'm just watching to see if we get a breakout here. But to me, this is one where if you look at other times, like when this broke out, it gave a pretty nice run here. And so I think it's not a very volatile area, but it is something people might kind of see and look at. And there are some REITs that are volatile and can really move. Things like SLG, for example, the SL Green, which is a New York City apartment company or no office company that can be a pretty high beta one. Um, so those are the main things I want to talk about today. Um, the other thing I want to say about the mortgages is that American mortgages have actually been have had very high yields relative to Treasury since the financial crisis. The actual credit spread, if you look at your average mortgage yield across against the 10-year, widened, 150, 200 basis points, since the financial crisis. So it means that even if the 10-year yield went down, mortgage yields didn't go down as much. And in the last few months, we've started to see this compress and narrow. And so I don't fully understand it. There's been a lot of strange things with Fannie Mae and all this stuff that you got to be a real, you know, mortgage geek to really appreciate. But the thing is that it's starting to narrow. And so we do have the potential here for if the 10-year yield kind of stays where it is, goes a little lower, we do have the potential of that other yield of the mortgage rates coming down. So from my view right now, housing might be in a spot that can potentially show some overall, opportunity. We've talked about housing in the past, and we were talking about open door, when it was coming off these lows. If you look back, we talked at the beginning of the housing trade back here. And so, I mean, this is something that, I think can spread. things move thematically. If a stock like this is moving and it's a housing related stock, these things too kind of spread to other areas. And so I think right now the home builders are something where people might remain kind of focused, especially with that data next week, the Fed next week, these expectations of lower rates. All right, those are the main things I wanted to talk about. Remember, we will be back on State of the Market on Monday. Going forward, we're not going to be well, actually, now if you want to see, if you go here to our events page on tradestation.com, our upcoming events will be listed here. We're not doing them as webinars anymore where you register. You can just go and watch them on YouTube. And they'll also be on Facebook and X, but we're going to be listing them as scheduled events on YouTube going forward. So we'll be back on Monday afternoon with State of the Market. Hope everyone has a great day, and I'll see you on